Welcome to a video that I like to call the deep dive video. Please don't let this name mislead you. I use it in a little bit different way. Every week I do videos each day, and I also do weekly videos and an intermarket analysis video. What I do for the last video of the week is I go back and I look through all the daily charts and I pick out those that I didn't really talk about all that much, if at all. I try to focus on the daily videos on charts that are actually telling us something, but we're leaving some information behind when we do that. So I like to go back, look at these charts, bring them up, show them to you. Some I only show in this video, just because we can get some insight from looking at those charts. Now, this video is a little bit different because last spring I did a supplemental video where I'm comparing stock prices with bond prices, and I did a whole extra video on that. Well, I had a number of charts that I used in that video, and I talk about them from time to time, but I took a longer list and I have updated versions of those charts. So I'm going to be looking at stocks versus bonds later on in the video to get some insight, and hopefully that will help us to see what's really going on in the market. We're really fighting right now. The market's been really going down. We're dealing with support. We're wondering, are we going to bounce up out of here, or are we going to continue to see some seasonal weakness going into the latter part of September? This is being prepared for Monday, September 25th. The first chart that we look at is the VIX, and I only show it in this video. The VIX is on here, but you don't see it. It's invisible. What I do is I plot a 50-period exponential moving average on top of the VIX, and that's the blue line that you see here, because usually we use static numbers with the VIX. We do 12 or so to the downside. That means that investors are really complacent, where when we're starting to show a lot of fear, we use 20 on the upside. Well, you can see by this chart, we break above 20 quite often. What we're looking for is a range. And as we go through different periods in the market, we set a different range with the VIX. And from 2008 up until about 2012, we had a really high range. Then we dropped down and set a lower range. And then after the COVID plunge, we had a higher range again. And we're looking way over on the right to see maybe we're starting to set a lower range. The VIX has been very low. Now there's a lot of this zero DTE options, and that's kind of skewing the VIX a little bit. That's why I also include some additional studies, but that may be having some impact as to why the VIX is staying really low. We also look at the VIX and then take a 3-month average of the VIX. And then from there, we look at a ratio. And what I follow mostly is the red line. And this is continuing to go up. That's showing that fear is increasing. But when you look at the VIX, it's still at a very low level overall. Then we also sometimes use a different calculation of the VIX. We take the VIX to S&P 500 correlation, because the VIX might not be really clear as to what's happening. So then we can look at this chart, and when it's spiking up and then coming back down, that typically means there'll be some kind of a big move in the market. Well, right now we're getting a low reading, which is why I haven't been showing this chart. Then we also look at another type of VIX called the skew index, where the VIX looks at the money options, the skew index looks at out of the money options. And when we get up into this red area, that means the market is expecting some kind of a big move. Sometimes it's marks a top, sometimes it marks a bottom, sometimes it just marks a continuation. We need to look at other charts to get the actual context. Right now, we're just about at the midpoint, so it's not really telling us all that much. And then I have the VIX along the bottom just as kind of a comparison. Then we look at the MOVE index, which measures the volatility of bonds, and that's been picking up a little bit as bonds have been coming under pressure based on price. But we also look at the VIX, and that's really been spiking up as we've been having trouble with stock prices. And then in this next area, the red is the S&P 500, which has been under pressure, and the green is the VIX minus the MOVE index, just to give us an idea what general direction is this moving. What I pay attention to the most is the correlation along the bottom, and it's pretty much neutral right now. We're seeing the MOVE index not move as much. And this is a newer index. It's only been around a few years, so there's not a lot of historical data to go back and do some testing. So I'm kind of testing this in real time, but this isn't really showing us all that much right now. Then we have the equity put call ratio. This is the daily chart. And as I explain each week with this video, this is the last chart to be updated. So I can't always include that in the daily videos. And we've been going up as the market has been going down. Now we ticked down just a little bit in Friday's session. Then we look at different variations of fear gauges. When fear is high, this gauge goes up. We can see over here, this really went up. Well, this has been really decreasing lately, but even in Friday's session, we ticked up just slightly. We also keep an eye on volume where it's tending to drop below average. Even on the down days that we've been seeing, volume has been dropping off. We keep an eye on where are we in relation to the all-time high. We're down 10.35% when we set the high back in early January 2022. And over on the right-hand side is about where we closed on Friday. Then stockcharts.com has a thing called technical alerts, and these are listed for the whole week. At the bottom is Monday, and it goes all the way up to Friday. When they're red, that's negative. When they're blue, that's more positive. I mainly just point this out to you. I follow these as the market is open each day, and they not only deal with indexes like the S&P, the Dow, the NASDAQ 100, they also look at different sectors, the 11 sectors that make up the S&P. And sometimes when we see a whole lot of red here, that typically means we're having some trouble. On other days, when we're going up, we might see an awful lot of blue or green on this chart. Then what we follow mainly are 5 indexes. We take the S&P, the Dow, the NASDAQ 100, the mid caps, and the small caps. And stockcharts.com also has another feature where if you type in that symbol, it will come back and give you what's called a technical score. This is where 0 is the lowest and 100 is the highest. So the closer we are to 100, the better technically that index is looking. And you can do this with individual stocks as well. Coming in first place are the QQQs. Now, we haven't really used this chart all that much because we've been flatlining even as the Qs have been going down. That's because earlier in 2023, we saw a real big up move, and those are still being registered on the charts. Now, that can be seen as negative, even though we've been going down. This is flatlining to declining just slightly, but this can also be seen as positive, that even though we've been going down, we're not seeing an awful lot of technical damage being done. But this week, it comes in first place at 93.3. Then in second place is the S&P 500, also declining as it's been under pressure. It's at 77.2. I only look at things when they're at 80, the high 80s to low 90s when I'm looking to go long. If I'm looking to go short, I want this number to be quite small. In third place is the Dow at 67.8. Then we have the mid caps at 38.3. And then, not surprising, we have the small caps in last place at 21.3. They've been under a lot of pressure lately. We're in a rising interest rate environment, and these are smaller companies, and quite often they have to borrow to be able to grow or just stay alive. And the rise in interest rates can really have more of an impact on smaller companies. Then some short-term charts that we look at. This is a 20-period double and triple exponential moving average. And we're dropping below both the blue and the green line and going down. And we're far away from this now, so I haven't been showing that. Here is a 20-period simple and exponential moving average where we're also dropping below that. We're seeing both the red line and the blue line start to go down. So in the short term, we are turning more negative. Then some intermediate term charts. This is a 50-period double and triple exponential moving average where the red line is below the green line. It would be more positive if the red line was above, and the red line and green line are starting to turn down and we're dropping below the 50. So those are more in the rear view mirror right now. We're going down and testing like the 100-day moving average and possibly down to the 200-day moving average. Here's a 50-period simple and exponential moving average study where we're dropping below both of them and they're starting to roll over slightly. Then we look at a number of different oscillators, and I usually show these, but I'm trying to keep the daily videos as short as possible. I try to keep them to 30 minutes. And so unless these give us some kind of an extreme reading, I haven't been showing these charts. The Chaikin oscillator is declining. That's negative. And if we do continue to fall, we might get an extreme negative reading. Also, the money flow is below 50 and declining and getting really close to an extreme negative reading. The ultimate oscillator, the same thing, below 50, declining near an extreme reading. The Copic curve is not generating any kind of a signal right now. When the black line crosses above the red line, that's when a buy signal is generated. We lost that, and now we've been declining. On balance volume just measures up volume versus down volume, and we've been going down lately, so we're seeing this also decline, and it's below a declining moving average. That's more negative. We also look at point and figure charts. These aren't based on time, they're just based on price. And when we're going up, X's are drawn. When we're going down, zeros or O's are drawn. And we had some O's earlier in the week, which added more to the negativity that we're seeing. Also, we're not getting any kind of a signal right now, but this is just turning a bit more negative. Then we have an intermediate term rainbow chart going from 50 periods up to 100 periods, where we're dropping down below the rainbow. Now, we haven't been here for very long, so these lines continue to go up. The longer we stay down below this rainbow, the more these lines are going to roll over, and that could turn more negative. We also look at the standard deviation based on 10 periods, which is like looking at the average price. We were chopping around, not going in any kind of a trend there for a while, and then all of a sudden we started to fall, and so we saw the standard deviation really pick up. I don't use this chart other than in this video. There's other types of standard deviation charts that I look at. Then the Pring bottom fisher is pretty good at picking bottoms in the market. Well, this is going flat right now and not giving us a signal. The Sean trend meter is also in a neutral area, but it is declining, so this is more negative. Then we compare the S&P 100 to the S&P 500, and we look for divergences or convergences here, and they're pretty much confirming each other at the present time. Some long-term charts. We have the daily special K chart, and I talk about this in every daily video, but I haven't been showing the chart because we might cross this 1 or 2 times in a year. Well, we crossed over positive in about the middle part of June, and we remain positive right now. But the weekly chart, which I don't have here, it is still negative. But this is giving more of the positive backdrop to the overall market. We also have an anchored moving average going back to the all-time high, and we're still well above this red line. We are declining now, but we're far away from this, so I haven't been showing this chart. Then we want to keep an eye on how far are we above or below the 200-day simple moving average. Even though we've been declining, we're still above that moving average. Here's a long-term rainbow going from 50 periods up to 250 periods. We're coming into the rainbow now and falling down with prices, but we haven't been in here very long, so these lines still continue to go up. So it's negative that we're falling, but it's positive that we're not seeing a longer-term decline with this rainbow. Then we look at a weekly chart of the S&P on top, and then the German DAX, which is their major index. Here's a weekly chart. And then we just look at the correlation between the two. Sometimes when this is really high, that means they're going in the same direction at the same time. Right now, they're pretty much not correlating with each other. Then we look at the US 10-year yield, and we subtract the German 10-year yield, and that gives us a result that we can plot up here. And believe it or not, there are times when we look at the next section down, we can compare that to the US dollar index, where sometimes, looking at the bottom area, there's a strong correlation between the two. It is getting stronger, but we're not up into this blue area at least yet, so I haven't been showing this chart. Then different areas of support and resistance, and the S&P specifically and all the indexes are dealing with support right now, but this is not one that they're currently dealing with. This is a downtrend channel upper line, okay? And that's what I talk about in each daily video. What I did is I drew from the June 2022 low to the October 2022 low. I drew a trend line there, and then I went up to the all-time high and then drew a parallel line. And as we were going up last May and into June, this was providing overhead resistance, but we were finally able to break above that. Now we're coming back down, and I'll probably extend this line, and if we continue to fall, this may come into play. But as long as we're still above this trend line, we are remaining more positive. We also look at what are called quadrant lines. I went from the COVID low to the all-time high, drew some lines on here, and each one of them is 25%. Okay, that may not seem like all that big of a deal, but earlier in 2023, this was really providing some significant overhead resistance. We were finally able to break through that, We're still above it, even though we've been declining. If we continue to fall, I'll probably start showing this chart again. And then we have longer term fib levels. And this is interesting in that the way these are measured, we actually have some Fibonacci levels on top of each other. And we're still far away from this green line that we're showing here. But if we continue to fall, I'll probably be showing this chart as well. Some broad market measures. This is the Vixen, where we have the VIX for the S&P. The Vixen measures the volatility of the NASDAQ 100. It has been spiking up lately, and I mainly follow the line chart on the bottom. Then we have some different studies. We look at discretionary, and we look at an equal weight ETF. We also look at a staples equal weight ETF. And then down at the bottom, we take a ratio between the two, where discretionary has been outperforming staples, but lately we're seeing this ratio coming down. Then we have a weekly chart of the QQQs, which is the NASDAQ 100. And then we have an anchored moving average going back to the all-time high, and we're still well above this level. The bank ETF, we really shot down back in March when we had some banks with some real problems. We keep an eye on this just in case there's more banking information that ends up coming out. But this continues to be in a downtrend where the blue line is below the red line, and we are declining. And then we look at the regional banking ETF, and it's really underperforming the financial sector as this has been going down. Then we also just look at the financial sector itself. It broke above resistance back in 2021 and went and set an all-time high. Now that we've been under some pressure in 2022 and into 2023, we did come back down, and what was once resistance now becomes support. We're still well above this level, so I haven't been showing this chart. Then we look at the S&P on top, and then we take a ratio between the Qs, the NASDAQ 100, and the diamonds, which is the Dow. And then what I mainly focus on is on the bottom, where the correlation right now is really strong between the two. We look at the Dow versus the transports, and the red line below the black line means the transports are underperforming. In a solid environment, we want to see the red line above the black line. And then this is a chart that I talk about in every video, but I haven't been showing it lately. On top here, actually in the middle, we have the NASDAQ new highs, new lows, and then we take a cumulative measure of that. And ever since about 2021, we've been seeing this really decline, and that's continuing, and that's adding more to the background weakness for the NASDAQ. Then we look at the raw score on the bottom, where we just take the new highs minus the new lows. When we're below zero, that's negative. When we're above zero, that's positive. Currently, we're below zero and declining. Then we look at the common stock on the NYSE. There's lots of things that are measured in the NYSE. This just looks at common stock, which is what we mainly focus on. We have an advanced decline line. We're chopping around and not really hitting any kind of a new high or new low right now. And then we compare that with volume on the bottom. We look for divergences or convergences here, and this really isn't telling us all that much. Then just to get a long-term perspective, we have a 250-day rate of change. This looks at the price right now and then compares it to where was it at 250 periods ago, and we're continuing to go up. So that's longer-term positive. Here's another look at that same chart, but going back to 1980, which gives us a little longer look, showing that we haven't surpassed this previous high, but we are still looking better. Then bonds, and then I have some additional bond charts to show you. On top is the S&P 500, and that is in red, and that's been declining. And the long-term bond ETF, the TLT, that's also been declining. So we're seeing a pretty strong longer-term relationship right now as this is going up based on 50 periods. We're also seeing the shorter-term 10-period relationship or correlation, also showing that bonds based on price and stocks are having a tendency to go in the same direction. And right now that is down. We keep an eye on the yield curve. The one that we watch the most is the 10 to the 2-year and the 10 to the 3-month. When they're below this red line, that means they're inverted. We also have a couple of other yield curves that we follow. These still remain inverted. We're watching this. We're seeing this ticking back up just ever so slightly, because when this goes back to being more regular, that's usually when we begin a countdown thinking, okay, are we going to head into a recession? Then this is a measure of bonds as they perform against stocks. And bonds have been underperforming based on price. But lately, even though bonds have been down, they've been holding up better than stocks have been. We look at value to growth. Now, typically, we look at growth to value ratios. This takes an inversion of that and looks at value to growth. That's the black line where it's been going up lately, but seeing some weakness. And then we compare that to the 10-year yield. Sometimes these have a tendency to go in the same direction. That's when we would get a high reading with the correlation chart. Right now, we're actually having a tendency to go in the opposite direction. And then we look at the QQQs, which is the black line here, and the TLT, which is the long-term bond ETF, and they're having a pretty strong tendency to go in the same direction. Unfortunately, that's down right now. Then we look at an equal weight version of the S&P 500. Then we take the MOVE index, which measures the volatility of stocks. We invert that, and we're supposed to get something useful out of this chart. This is a newer chart to me, and I'm still trying to figure this one out. I'm not really getting any insight from this. Then we look at the 3-month yield. We're climbing above where we were back in 2007, and I mentioned this in every daily video. What we're waiting for is to see if we top out and then start to come down, just like we did back in 2007. And if we do that, is that going to issue some kind of a warning sign? Then here's some of the newer charts that I showed back in the supplemental video. And I have shown this from time to time in the daily videos. We take the 1 to 3 month T-bill, which you could pretty much count that as cash. And then we compare that with the 3 to 7 year bond. When this is going up, that means that there's a lot of uncertainty about interest rates. When I first did the supplemental video, this ratio was starting to go down. It looked like, okay, we're maybe done raising interest rates. Well, then we ran into some problems and now we're starting to go back up. So this is more negative, suggesting that interest rates are having a tendency to still climb higher. Then on the next chart, we see the 1 to 3 year Treasury bond ETF, that's shorter term, and we compare it with the 3 to 7 year Treasury bond ETF. And this is shifting to going back up. So since June, the shift has gone back to rising interest rates. When this is going down, and about the time I did the video last spring, this ratio was really starting to decline, looking like, maybe they're done raising interest rates. Nope, that's not what's happening ever since that time, and this is continuing to go up. Then we look at an inverse of that same chart, where we look at longer term bonds and their ETFs. We compare them with shorter term bonds, where this is continuing to decline, and that's pretty much confirming what we saw on the previous chart. Then we look at junk bonds, which they often give you a higher yield, but they also make you assume more risk. Now, if the market was really concerned about this, we would see this ratio going down, and it has been going down lately, but we would see more of a sustained decline, and that's not what we're seeing right now. As of the 25th, which is Monday, the day before, actually I'm recording this the day before that day, so this is really as of the close on Friday, the junk bond average year yield to maturity was 8.64%. Okay, would you like to get that kind of a yield? Well, a lot of people think that, so that's why this ratio is going up. Compared to the government bond, the 3 to 7 year Treasury bond, it's yielding 4.69%. So you're getting a lot more, almost 4% more, by assuming more risk. And that's why we see this continuing to go up. Then we look at the QQQs and compare it to the 3 to 7 year bond ETF, where the Qs have been outperforming, although we are seeing some weakness more as we've been battling through September. And then we look at the intermediate term bonds. These are corporate bonds. And we compare that with government bonds. Intermediate term bonds typically will pay more with their yield because they're considered risky, where government bonds are considered to be pretty much risk-free. Where we look at the SPIB, where the yield is 5.96%. Would you rather get that, or would you rather get a safe return at 4.22%? A lot of people want the higher yield right now, so that's why this ratio is going up. Then we look at the S&P and compare it to bonds. And I was showing this for a long time in the daily videos, but we've been going sideways to declining. When we're above and going up, that suggests that the market is anticipating a soft landing, meaning that we might have an economic slowdown, but we're not necessarily going to go into a recession, versus a hard landing, which is where we do go into a recession. And even though this is weakening, we're still in a longer term uptrend. Then we look at a thing called TIPS, and these are Treasury inflation protected securities. When interest rates are really going up, you get into one of these types of securities, and then you can roll them over and have a higher interest rate the next time, or they also adjust depending on what interest rates are doing. When we were really going up, folks were favoring tips. Well, lately we still continue to go down, even though there are inflation worries, even though the market's in decline, even though interest rates are going up, we're still seeing this decline overall. So that's longer term more positive. Not saying that this is right, but this is what the market is interpreting. And then we look at the Eurozone. We want to look outside of the US and compare it to government bonds, where the Eurozone had been really outperforming, but also seeing some recent weakness. Then we look at home construction, an area that is very sensitive to interest rates. And we had been really going up, but now we're starting to see some weakness. Then I also have a thing called the possible positive scenarios. When we're going down like we are now, and you might be seeing some of these charts in the daily videos pretty soon if we continue to fall. But when we see a lot of these charts coming together at the same time, a lot of times that will suggest that maybe we've hit some kind of a bottom. There's also other charts that we look at where we compare growth versus value. And that's the first chart that we see. We compare the QQQs, which is more growth when compared to the SPY, and it's been pretty much chopping sideways. Discretionary, which has been doing better in 2023, it's also seeing some weakness, and we compare large cap growth with large cap value, and it's also underperforming. Then we have some growth to value ratios. The large cap is showing weakness, the mid caps and the small caps. Then we look at a 10-day average of the S&P 500 highs minus the lows. The negative thing about this chart is we're dropping below 50. Now, we can also use this as an oscillator. When we get to extreme positive readings or extreme negative readings, we're far away from that right now, but we are leaning more negative with this chart. Then we look at the Amex, the NASDAQ, and the NYSE, and we take a 5-period moving average of their highs minus the lows. When we're below zero and declining, that's more negative, and that's a broader measure of the market. Then we look at the percent of stocks in the S&P that are above or below their 200-day simple moving average. And this is really decreasing as well, showing that there's more negativity. On a longer term basis, we can use this like an oscillator to get an extreme positive or negative reading, but we're not getting that right now. Then we also look at a 50-period exponential moving average of the new highs minus the new lows. When we're in the blue area, we're positive, and that's where we are right now, but we are coming down with this red line. Where we get this chart from is this next chart, where the black line is the actual indicator, and then on top of that is plotted a 50-day exponential moving average. And that's declining, and that's why we're seeing the red line declining on the previous chart, and we're actually in danger of dropping below zero. This indicator would turn more negative if we do drop below that zero level. Then we look at the 19-day exponential moving average of the advanced decline ratio. We do this based on price and volume. When we're below zero and declining, that's negative, and we're doing that right now based on price and volume. We can also use these like oscillators. If we get to some extreme negative readings, that may help to mark a bottom. Then we look at the S&P 500 again, and we look at the 50-period moving averages. What stocks in the S&P are above that? And we're seeing this dropping down as well. So that's turning more negative. We can also use this like an oscillator. Then we also keep an eye on the mid caps, which are showing some weakness, and we're also keeping an eye on the small caps, which are also continuing to show weakness. Then we look at the 2-year Treasury yield. Sometimes when this goes up and then starts to come back down, that will mark some short to intermediate term support for the S&P. The problem is this is continuing to go up, so it hasn't been all that helpful. Then this is one I rely on quite heavily, and I mention it in every video. This looks at the Staples to S&P 500 ratio. When this is going down, when we've topped up and started to go down, that often gives really good support to the S&P. Right now, we have been declining, and that didn't give an awful lot of support as we were dealing with September. But this is starting to go back up now. So this is actually turning more negative. So thank you. I hope you found this helpful. Please feel free to check out the videos. This is not meant to be watched all by itself. This is to give you more context to the other videos that I also post. I hope that you have a great weekend, and I will talk to you in the next video.